Question 1. Scenario-based question. Mr. Anderson, a 65-year-old retiree, is considering purchasing a fixed immediate annuity. He wants the annuity to start paying him monthly income as soon as possible and for the rest of his life. After discussing with his insurance agent, Mr. Anderson is presented with two options. Option A fixed immediate annuity that pays a monthly income for life with no inflation protection. Option B, a fixed immediate annuity with a monthly income that adjusts annually for inflation, but it starts payments 1 year after purchase. Mr. Anderson is concerned about his future purchasing power and wants to make sure that inflation won't significantly affect his income over time. What should Mr. Anderson do based on his concerns and financial goals? They choose option A, as it starts payments immediately and provides a fixed income for life, which is ideal for someone with a limited life expectancy. B, choose option B, as the inflation adjustment feature will better preserve his purchasing power over time, despite the delayed start in payments. C, choose option O, because immediate income is more important to him than inflation protection, and he is confident in his ability to handle any future income decreases. D, decline both options and look for a deferred annuity with a more flexible payout schedule despite the delayed payments. Answer B, explanation. Mr. Anderson's primary concern is inflation and how it might erode the purchasing power of his income over time. In this case, option B, which includes an inflation adjustment feature, addresses his concern by allowing his monthly payments to grow over time, keeping pace with inflation. Though the payments start a year later, this feature ensures that his income remains more stable in real terms throughout retirement. While option A offers immediate payments, it lacks the inflation protection Mr. Anderson seeks, which could result in reduced purchasing power in the long run. Question 2. Which of the following statements about fixed indexed annuities is correct? A, fixed indexed annuities guarantee a fixed rate of return based on an index, which can be greater than the initial premium. B, fixed indexed annuities offer returns tied to an equity index but guarantee a minimum interest rate regardless of the market performance. C, fixed indexed annuities allow the policyholder to directly invest in equities, giving them the potential for unlimited gains. D, fixed indexed annuities have no participation rates, caps, or spread fees, meaning policyholders receive the full market return without any limitations. Answer B, explanation. Fixed indexed annuities (FIAs) are designed to offer returns based on the performance of an underlying equity index, such as the S&P 500, while providing some level of protection against market losses. They do not directly invest in equities, but use the index as a benchmark to determine the returns. The key feature of FIAs is the minimum interest rate guarantee, which ensures that the annuity holder's investment will not lose value even if the index performs poorly. However, returns are subject to caps, participation rates, or spreads limiting the potential gains. Option B correctly reflects the guaranteed minimum interest rate aspect and the market-linked returns. Question 3. What is the primary purpose of the Suitability in Annuity Transactions Model Regulation for insurance producers? A, to provide insurance agents with guidelines on how to handle annuity claims and disputes. B, to establish standards for evaluating whether an annuity product is suitable for a customer based on their financial profile, needs, and objectives. C, to protect insurance companies from liability in the event of market downturns affecting annuity investments. D, to dictate the specific types of annuities that insurance companies can offer in Illinois. Answer B, explanation. The Suitability in Annuity Transactions Model Regulation is designed to ensure that insurance producers recommend annuity products that are suitable for their clients based on a thorough assessment of their financial profile, goals, and risk tolerance. It mandates that the producer consider the customer's age, income, financial situation, and investment objectives before recommending an annuity. This regulation helps to prevent mis-selling and ensures that consumers are provided with products that best meet their needs. While options A, C, and D focus on other aspects of annuity transactions, option B is the most accurate and directly aligns with the purpose of this model regulation. Question 4. Which of the following is a characteristic of a joint and survivor annuity option? A, it provides payments to only the annuitant for a specified period after which payments cease. B, it guarantees a set monthly payment for the annuitant's life and continues for the life of the beneficiary, typically a spouse. C, it allows the annuitant to change the beneficiary after the annuity has started. D, it provides payments to the annuitant, but only if they live past a predetermined age. Answer B, explanation. A joint and survivor annuity is designed to provide lifetime income to two individuals, typically spouses. After the death of the primary annuitant, the annuity continues to provide payments to the survivor, the beneficiary, for the remainder of their life. This option is particularly useful for those seeking to ensure that the surviving spouse continues to receive income after the death of the annuitant. Unlike option A, which describes a period certain annuity, or option C, which would not typically be available in a joint and survivor annuity, option B correctly reflects the essence of this option. Question 5. Which of the following is not a prohibited practice under Illinois insurance law when selling annuities? A. Failing to disclose the surrender charges and fees associated with the annuity. B. Churning or recommending unnecessary replacement of existing annuities to generate commissions. C. Providing accurate, non-misleading illustrations of the potential growth of an annuity. D. Misrepresenting the tax treatment of annuity products to potential buyers. Answer. C. Explanation. Under Illinois insurance law, it is considered a prohibited practice to misrepresent or fail to disclose important information regarding annuities, such as surrender charges, option A, or the tax implications, option D. Churning, option B, which refers to the unethical practice of recommending unnecessary annuity replacements to generate commissions, is also prohibited. However, option C is not prohibited. Insurance producers are allowed to provide accurate and non-misleading illustrations as long as the information presented is truthful and not misleading. This is in line with the principles of transparency and ethical sales practices. Question 6. Scenario-based question. Scenario. MS. Thompson, a 70-year-old retiree, is considering converting her current 401k balance into an annuity for guaranteed monthly income. She is unsure whether she should choose a fixed or variable annuity. MS. Thompson is risk-averse and would prefer a predictable income stream, but is concerned about inflation eroding her purchasing power over time. Which option would be most suitable for MS? Thompson, given her preferences, a fixed annuity, as it offers guaranteed income for life and protects against market volatility, but it does not address inflation concerns. B. A variable annuity, as it offers potential for growth tied to the performance of underlying investments, which could offset inflation risk. C. A fixed indexed annuity, as it provides some level of growth potential while still offering the security of a minimum interest rate. D. A multi-option annuity, as it combines both fixed and variable options, which will give her the flexibility to manage both risk and growth. Answer. C. Explanation. MS. Thompson is risk-averse, meaning she is not willing to take on significant market risk, but she is concerned about inflation over time. A fixed annuity, option A, would provide guaranteed income for life but would not address her inflation concerns, as it offers a fixed rate of return. A variable annuity, option B, exposes her to market risk, which contradicts her preference for predictability. A fixed indexed annuity, option C, offers a guaranteed minimum return along with potential growth tied to an index, which can help combat inflation without taking on significant market risk. Therefore, option C is the most suitable option for her needs. Question 7. What is the primary purpose of the guaranteed minimum withdrawal benefit double-eyed in annuity? A. To guarantee that the annuitant will receive a minimum number of payments regardless of life expectancy. B. To guarantee the return of premiums to the annuitant in the event of death. C. To allow the annuitant to withdraw a minimum amount of income each year regardless of the investment performance of the annuity. D. To ensure the annuitant's payments are adjusted annually to reflect changes in the cost of living. Answer. C. Explanation. The guaranteed minimum withdrawal benefit rider guarantees that the annuitant can withdraw a minimum amount of income each year, regardless of the performance of the underlying investments. This rider ensures that the annuitant will not outlive their income even if the annuity's investments perform poorly. Option. It describes a feature more typical of period certain annuities, and option B focuses on death benefits, which is a different rider. Option D, while relevant for inflation protection, is not a feature of the GMWB rider. Therefore, option C is the correct choice. Question 8. Which of the following statements about tax-deferred annuities is accurate? A. The premiums paid into a tax-deferred annuity are taxed at the time of contribution. B. The earnings in a tax-deferred annuity grow tax-free until withdrawal, at which point the entire withdrawal is taxed as income. C. Tax-deferred annuities are subject to the same tax treatment as Roth IRAs. D. The earnings on a tax-deferred annuity are taxed at a reduced rate when withdrawn. Answer. B. Explanation. A tax-deferred annuity allows earnings to grow without being taxed until withdrawal. At the time of withdrawal, the earnings are taxed as ordinary income, while the principal, the original investment, is not taxed again. This is a key feature of tax-deferred annuities. Option is incorrect because the premiums are made with after-tax dollars, not taxed at the time of contribution. Option C is incorrect because tax-deferred annuities do not share the same tax treatment as Roth IRAs, which allow for tax-free withdrawals under certain conditions. Option D is also incorrect because the earnings are taxed at ordinary income rates, not a reduced rate. Question 9. Which of the following is a key disadvantage of variable annuities? A. They guarantee a fixed rate of return, which makes them ideal for long-term growth. B. They offer no death benefit protection to beneficiaries. C. They expose the annuitant to market risk, which could result in a loss of principal. D. They require the annuitant to pay a penalty for early withdrawals during the first 10 years of the contract. Answer C. Explanation. Variable annuities are tied to the performance of underlying investments such as stocks or bonds. This means they expose the annuitant to market risk, and there is a possibility that the value of the annuity could decrease, including a loss of principal. Option A is incorrect because variable annuities do not guarantee a fixed rate of return, and they depend on market performance. Option B is inaccurate because variable annuities typically include a death benefit to protect beneficiaries. Option D is misleading as variable annuities may have surrender charges but do not necessarily penalize early withdrawals based solely on the duration of the contract. Question 10. What does the accumulation period of an annuity refer to? A. The period during which the annuitant receives regular income payments. B. The phase during which premiums are paid into the annuity and the account value grows. C. The time it takes for an annuity to reach its full payout value. D. The duration for which the insurance company pays the annuitant's death benefit. Answer B. Explanation. The accumulation period is the phase of the annuity contract when the annuitant makes premium payments and the annuity's value grows through interest or investment returns. This period is followed by the payout period where the annuitant begins receiving income. Option A refers to the payout period, while option C is not an accurate description of any specific period in an annuity contract. Option D is incorrect because death benefits are not tied to the accumulation period. They are typically payable at any time during the contract. Question 11. What is the key benefit of purchasing a fixed annuity? A. The annuitant's income payments are subject to fluctuations based on market performance. B. The annuitant receives a fixed, guaranteed income for life or a specified period. C. The annuitant's premiums are invested in stocks or bonds to generate returns. D. The annuitant can withdraw their principal at any time without penalty. Answer B. Explanation. A fixed annuity provides the annuitant with a guaranteed, predictable income either for life or a specified period. The key benefit is the security of fixed payments unaffected by market performance. Option A describes a variable annuity, while option C refers to investment strategies used in variable annuities. Option D is incorrect, as fixed annuities typically have surrender charges or penalties for early withdrawals. Question 12. Which of the following best describes a deferred annuity? A. Payments to the annuitant begin immediately after purchase. B. The annuity grows during the accumulation phase and income payments are delayed until a future date. C. The annuitant must choose a lump sum payout within 12 months of purchasing the annuity. D. The annuity offers a fixed rate of return with no market risk involved. Answer B. Explanation. A deferred annuity accumulates funds during an accumulation phase, and income payments are delayed until a future date, typically after retirement. Option A describes an immediate annuity, while option C is not a standard feature of deferred annuities. Option D could describe a fixed annuity but does not directly relate to the deferral of payments. Question 13. Which of the following statements is true regarding the life-only annuity option? A. The annuitant will receive payments for life, but the payments stop when the annuitant dies with no benefits to beneficiaries. B. The annuitant receives a lifetime income, and upon death, the remaining payments go to the beneficiary. C. The annuitant's income payments are guaranteed for a set number of years, even if the annuitant dies early. D. The annuity provides lifetime income, but it can be converted to a lump sum at any time. Answer A. Explanation. A life-only annuity option guarantees payments for the annuitant's lifetime, but no payments are made to beneficiaries after the annuitant's death. This type of annuity has the lowest payout rate because it does not provide a death benefit. Option B describes a joy-intense survivor annuity, while option C refers to a period-certain annuity. Option D describes a feature not typically available with life-only annuities. Question 14. Which of the following is an example of a longevity annuity? A. A fixed annuity that begins payments immediately after purchase. B. A variable annuity with a death benefit provision. C. An annuity that begins paying out at a very advanced age, typically 85 or 90. D. An annuity that guarantees payments for a set period, such as 20 years. Answer: C. Explanation. A longevity annuity, also known as a deferred income annuity (DIA), starts payouts at an advanced age, often 85 or 90, and is designed to protect against the financial risk of outliving one's savings. Option is an immediate annuity, option B is a variable annuity, and option D refers to a period certain annuity, not a longevity annuity. Question 15. What is the key advantage of purchasing a variable annuity? A. The annuitant receives a fixed, guaranteed income. B. The annuitant's income payments are subject to market performance, offering the potential for growth. C. The annuitant is guaranteed to receive the principal amount invested, regardless of market performance. D. The annuity guarantees income payments will increase to match inflation each year. Answer: B. Explanation. A variable annuity allows the annuitant to invest in a range of market-based investment options, meaning the income payments are subject to the performance of those investments. This provides the potential for higher returns, but also exposes the annuitant to market risk. Option A describes a fixed annuity. Option C is incorrect because variable annuities do not guarantee the return of principal, and option D is not typical of variable annuities, although some may offer inflation-adjusted options. Question 16. Which of the following would most likely cause an annuity's surrender value to be lower than the total premiums paid into the contract? A. The annuity's funds are invested in low-risk bonds. B. The annuity has high early withdrawal penalties or surrender charges. C. The annuity guarantees a fixed income regardless of market conditions. D. The annuity is purchased with a long payment period. Answer: B. Explanation. Surrender charges are fees that apply when an annuity is cashed out early. These fees typically decrease over time, but if the annuitant surrenders the annuity early, the surrender value may be significantly lower than the total premiums paid. Options A, C, and D describe features that do not inherently cause the surrender value to be lower than the premiums. Question 17. Which of the following best describes an immediate annuity? A. It provides periodic income payments that begin after a deferral period, often years later. B. It requires the annuitant to make a lump sum payment, and payments begin immediately. C. It guarantees payments for a set period regardless of the annuitant's life expectancy. D. It allows the annuitant to withdraw funds as needed, similar to a savings account. Answer: B. Explanation. An immediate annuity starts paying income to the annuitant immediately after the premium is paid. It's typically used for retirees seeking a predictable income stream right away. Option A describes a deferred annuity. Option C refers to a period certain annuity, and option D does not apply to annuities. Question 18. What is typically the primary purpose of adding a death benefit rider to an annuity? A. To ensure the annuitant's beneficiaries receive a lump sum payment if the annuitant dies before receiving any payments. B. To guarantee that the annuitant receives a certain minimum number of monthly payments regardless of life expectancy. C. To provide a higher income to the annuitant after death. D. To ensure the annuitant's premiums are refunded to beneficiaries in case of death. Answer A. Explanation. The death benefit rider ensures that if the annuitant dies before receiving any income payments or before the full premiums have been paid out, the beneficiaries will receive a lump sum payment, often equal to the premium paid into the annuity or the account value. This option is primarily used to protect the family's financial interests. Option B refers to a period certain annuity. Option C is incorrect because no higher income is typically provided after death, and option D may be an aspect of some annuities, but is not the primary function of a death benefit rider. Question 19. Which of the following is true about fixed indexed annuities? A. They offer guaranteed returns regardless of market performance. B. The return is based on a stock market index, such as the S&P 500, but with a guaranteed minimum return. C. They provide a fixed rate of return, similar to a fixed annuity. D. They allow the annuitant to select individual stocks and bonds to invest in. Answer B. Explanation. Fixed indexed annuities link returns to a stock market index such as the S&P 500, offering the potential for higher returns than a fixed annuity, but with a guaranteed minimum return to protect the principal. Option is incorrect because there is potential for variable returns. Option C describes a fixed annuity, and option D refers to variable annuities, not indexed annuities. Question 20. How are withdrawals from an annuity generally taxed? A. The entire withdrawal is taxed as long-term capital gains. B. Withdrawals are taxed as ordinary income, with the earnings portion taxed first. C. Only the principal is taxed at the time of withdrawal. D. Withdrawals from an annuity are tax-free if the annuitant is over 591 wo. Answer. B. Explanation. Withdrawals from an annuity are taxed as ordinary income and the earnings portion is typically taxed first. The last in, first out rule. This means that the initial contributions, which are made with after-tax dollars, are withdrawn tax-free, but the earnings are taxed. Option A is incorrect because withdrawals are not taxed as capital gains. Option C is incorrect because the principal is not taxed when it is withdrawn first. And option D is false because withdrawals are still subject to taxation unless specific conditions apply, such as meeting the requirements for qualified distributions. Question 21. What is the primary purpose of a period certain annuity? A. To guarantee a fixed income for the annuitant's lifetime. B. To provide income for a set period, regardless of whether the annuitant is alive or not. C. To provide income that increases with inflation each year. D. To offer income only if the annuitant lives beyond a specific age. Answer. B. Explanation. A period certain annuity guarantees income for a specified number of years, regardless of whether the annuitant is alive or not. If the annuitant dies before the period ends, the remaining payments are typically made to the beneficiaries. Option A refers to a life annuity. Option C describes an inflation-adjusted annuity, and option D refers to a longevity annuity. Question 22. Which of the following is a potential drawback of a variable annuity? A. The annuitant is guaranteed a fixed return. B. The annuitant may lose principal if the investments perform poorly. C. The annuitant cannot access the funds until retirement age. D. The annuitant is required to purchase additional insurance coverage. Answer. B. Explanation. A variable annuity's performance depends on the underlying investment choices, typically mutual funds or stock market indices. If the investments perform poorly, the annuitant may lose some or all of their principal. Option is incorrect because variable annuities do not guarantee a fixed return. Option C is not true as variable annuities allow partial withdrawals or loans under certain conditions. Option D refers to a common misconception: additional insurance is not a requirement. Question 23. What happens when an annuitant surrenders an annuity before the contract surrender period ends? A. The annuitant must pay a penalty fee, but there are no taxes on the withdrawal. B. The annuitant may incur a surrender charge, and the earnings portion of the withdrawal will be taxed. C. The annuitant's premiums are refunded in full. D. There is no penalty, but taxes are incurred based on the entire amount withdrawn. Answer. B. Explanation. If an annuitant surrenders an annuity before the surrender period ends, they typically incur a surrender charge, and any earnings in the contract are taxed as ordinary income. Option is incorrect because taxes do apply to the earnings portion. Option C is incorrect because a full refund of premiums is not guaranteed. Option D is not accurate because only earnings, not principal, are subject to tax. Question 24. Which type of annuity guarantees income payments for the life of the annuitant and a beneficiary? A. Life-only annuity. B. Joint and survivor annuity. C. Period certain annuity. D. Fixed annuity. Answer. B. Explanation. A joint and survivor annuity guarantees income payments for the lifetime of the annuitant and their designated beneficiary, typically a spouse. If the annuitant dies, the payments continue to the beneficiary. Option A only provides income for the annuitant's lifetime. Option C guarantees income for a set period, and option D is unrelated to the type of income payment structure. Question 25. Which of the following would likely influence the payout amount of a fixed annuity? A. The investment portfolio chosen by the annuitant. B. The length of the payment period and the annuitant's age at the time of purchase. C. The stock market's overall performance during the annuity's life. D. The annuitant's credit score at the time of purchase. Answer. B. Explanation. The payout amount of a fixed annuity is determined by factors such as the length of the payment period and the annuitant's age when purchasing the annuity. Generally, older individuals receive higher payouts because their life expectancy is shorter. Option A applies to variable annuities. Option C is not relevant to fixed annuities, and option D is unrelated to annuity payouts. Question 26. What is the free look period in an annuity contract? A period during which the annuitant can change their mind and receive a full refund of premiums. B. The time during which the annuitant can withdraw funds without penalty. C. The period when the annuitant's premiums are invested in the market. D. The period when the annuity's value is guaranteed to increase. Answer A. Explanation. The free look period is a specified time frame, usually 1030 days, during which the annuitant can cancel the annuity contract and receive a full refund of premiums without incurring any penalties. Option B is more relevant to withdrawal terms. Option C refers to the accumulation phase, and option D is not. A standard feature of annuities. Question 27. Which of the following is true about a guaranteed minimum withdrawal benefit to provide in annuity? A. It guarantees the annuitant a specified income stream regardless of market performance. B. It guarantees that the annuitant can withdraw their initial premium amount without penalties. C. It guarantees the annuitant's principal is returned regardless of the market's performance. D. It provides the annuitant with a lump sum death benefit. Answer B. Explanation. The guaranteed minimum withdrawal benefit ride ensures that the annuitant can withdraw a set percentage of their initial premium over time, even if the market performance causes the account balance to fall below the original amount. It does not guarantee income for life, which is a different benefit. Option A refers to a guaranteed lifetime withdrawal benefit. Option C is incorrect because GMWB does not guarantee the return of principal, and option D is unrelated to withdrawal benefits. Question 20. How do qualified annuities differ from non-qualified annuities for tax purposes? A. Qualified annuities are purchased with after-tax dollars and are tax-deferred. B. Non-qualified annuities allow for tax-free withdrawals after 591 O. C. Qualified annuities are purchased with pre-tax dollars and have tax-deferred growth. D. Non-qualified annuities offer no tax advantages. Answer C. Explanation. Qualified annuities are purchased with pre-tax dollars, often through employer-sponsored retirement plans, and their growth is tax-deferred until withdrawals are made. Non-qualified annuities are purchased with after-tax dollars and offer tax-deferred growth on earnings, but the principal is not taxed upon withdrawal. Option is incorrect because qualified annuities are typically funded with pre-tax dollars. Option B is incorrect as both types of annuities may have tax penalties before 591 WO. Option D is false because non-qualified annuities still offer tax-deferred growth. Question 29. Which of the following is true about the rider on an annuity contract? A. It is a standard feature included in all annuity contracts. B. It is an optional feature that can be added for an additional fee to modify the terms of the annuity. C. It allows the annuitant to withdraw principal without penalty. D. It guarantees that the annuitant will receive a lump sum upon surrender. Answer B. Explanation. A rider is an optional feature that can be added to an annuity contract for an additional fee, providing customized benefits such as income guarantees, death benefits, or long-term care benefits. Option is incorrect because not all annuity contracts include riders by default. Option C is not true for all riders, as some riders may allow withdrawals, but they do not generally eliminate surrender charges. Option D is incorrect because riders do not provide guaranteed lump sums. Question 30. Which of the following is true about an annuity's accumulation phase? A. It is the period during which the annuitant receives periodic payments. B. It is the phase when the annuity's value grows, typically through premium payments and investment returns. C. It only lasts for a set number of years, after which no additional payments are possible. D. It is the period during which the annuitant's principal is guaranteed. Answer B. Explanation. The accumulation phase is the period during which the annuity's value grows, typically through premium payments made by the annuitant and potential investment returns. Option A refers to the payout phase. Option C is not true, as the accumulation phase can last for many years, and option D is incorrect because guarantees of principal are typically only available in certain annuity types, such as fixed annuities.